Now we're going to walk through refined products, and we're really going to start with diesel just because it's something that remains an overhang heading into the shoulder season. And we just want to start with just what does the overall picture look like as we really start to head into some what we think is going to be a problem, especially if we have a late start to the winter. We want to look at distillate. So when we look at distillate, we had a small draw of about 1.67 million, really driven by PADD 3. And again, this comes down to we had refiners that weren't back yet. So this just resulted in more being pulled from storage because refiners weren't replenishing it, which is something that was repeated as well in gasoline. So this is something where it's going to start to turn around. The problem is there should have been a bigger draw based on how refiners weren't coming down, and the fact that there wasn't leaves us concerned, especially as we're now in that shoulder season. So here you can see seasonally adjusted, we still remain at all-time highs, based on the, going back the last 30 some odd years. So you can see that there's that growing problem. Now, distillate is a little bit better in terms of some, there are some tailwinds when we talk about trucking and we start to look at rail, but this is something to watch. Like, this is what refiners are really going to look at when you're looking at gas oil. You're looking at, what is the global product market look like and what are the refiner margins look like. This is going to continue to weigh on those margins, which is what we think is going to cause additional refiners to either go into extended turnaround, or we're going to start to see additional economic run cuts, because this is a global issue, which is what we're going to talk about a little bit more in our third segment, looking at exports. So just kind of jumping right in, we're going to look at what does demand look like. We've been pretty consistent. We think it's going to kind of hang around that 5-year average. We normalized a little bit, but again, we have some tailwinds. Specifically in trucking, which we're going to talk about. Rail is getting a little bit better, but if you have some time, go to our econ show where we really look at imports and exports on a global level, broken up into Europe, Asia, and the US, where we see those slowdowns really starting to accelerate on an import level, coming into the US, coming into other nations, which is going to weigh on just global exports, which is going to be a bigger overhang because shipping is a huge consumer of diesel. And this is going to be a bigger problem, or diesel, marine gas oil, however you want it, whatever nomenclature you want to use, or pricing metrics, that's going to be a weight which is why we think we're just going to kind of hang around this kind of normalized level, especially as we get some big builds in Europe. Which now, while some of them are big, it's still normalized. But again, we're going to talk about that a bit more in terms of the different sides of that equation. Now, when we look at U.S. rail traffic, last week we talked about how we were starting to get a little bit more bullish on rail, specifically in grains, because we have a big harvest coming. We saw and a big harvest, not so much in terms of size, but in terms of getting it to the coast, only because we have a big demand coming from Europe. Coming from Asia, specifically Asia, because there is that global shortfall for food, driven based on lack of swine flu killing out the pig herds. That means that you need more beans to try to substitute some of the proteins. You need corn to help feed new pigs to try to regrow that herd, and you just have locusts, you have flooding. So there's all of these issues that it just means we have a strong market for U.S. exports, specifically in agriculture, which is why we see those grains going up, and we should see that really kind of continue and get some of those tailwinds. Motor vehicle parts is something that's interesting to see. We're still down a lot versus 2019, but it's nice to start to see a little bit of a normalization. But the overhang, obviously coal is going to be an overhang. But the other thing is going to be when we look at petroleum products, and again, this is coming back to not seeing the same type of demand for moving oil around, moving refined products around. So net, we think that we're going to get a continued positive move. We're still down versus 2019, but the gap is closed. If you remember, we've been averaging 15.8% to 16% down versus last year. Here, we're only down 7%. We're still down on an aggregate 15.8%, but again, things will start to get a little bit better, really supported by that agriculture side. And then looking at, can't stop, won't stop when you look at truck movements, and the demand is just there. Like, this is something where we thought we were going to start to see a little bit of a rollover, but it really continued straight through. Now that we're getting towards the end of back to school buying, we're starting to see some of those supply chains normalize. And now that we're seeing imports come down at the coast, because if you think of it, everything comes to the coast, then it either sits at the coast or goes right onto a train car, and then it starts moving inland. So intermodal's gotten better on the rail side, and trucking remains very strong. But now, as we have the coast, less stuff coming to the coast, that's going to start to show up, where you're going to start to see some of these normalizations. Now, we just expect some of this truck demand to normalize. We're not talking about a huge walk back. It's just, this is a huge bump, and we're starting to see a little bit of a normalization, especially when you look at when you start looking at truck availability. So truck availability is back to the lows that we've seen, through the essentially December, as we look through the end of 17, 18, and 19, where we have that truck availability really coming down. And we have some of these rates coming back up. And we always look at refrigeration because those are always the most expensive. And you can see that they're easily pressing to 2018 highs. And just as those rates start to go up, people are going to start to look at, okay, well, do I really need it right away? What does the cost look like? So that's why we think there's going to be a little bit of a normalization. But again, great tailwind for diesel demand, especially as we go through the shoulder season. Now, turning a little bit to gasoline, this is the first time since March that we're back in that little cloud. So I can't say that we're at a seasonally adjusted all-time high, but it's nice to see that we're getting in there. But again, we're getting to a point where we start to see this kind of flattening out and starting to rally, starting to increase in terms of storage, just based on the demand cycle. And the problem is, if you look at what the API reported, which was a draw of 6 million, and if you think about how many refiners were down, we should have seen a much bigger draw. And the fact that we didn't, it starts to speak towards the bearishness that we start to see, especially as we go through shoulder season. And when we look at Pad 1 had another big draw of 2.8 million. So on a net level, we drew about 3 million barrels out of storage, and it was really driven by Pad 1. Now, the reason why we keep showing imports is because there is going to be a surge of imports. Now, we talked about it in the end of August into September. And then all of a sudden, they're starting to get some concern that not as many exports were going to come from Europe into the U.S. And that's actually reversed. So now we've seen some stabilization. We've seen new product get signed up to come onto tankers. Right now, we're at about an additional 18 to come over from Europe into specifically Pad 1 or the East Coast, which is going to show up in these imports. We're expecting it. They should start to come here beginning to middle of this week and to next week, and then start to accelerate through the end of September. Because if you remember, when we had the Colonial Fire, then we had Hurricane Laura, there was this pricing, this arbitrage opened up. So a lot of shipments were signed up during that time period. So that means that imports, as long as they're not resold, will start to show up within the U.S. as we go through the remainder of September. So that will also start to show up in Pad 1. And as we see just headwinds when we're looking at driving, that's going to also weigh and will accelerate some of these builds, specifically in gasoline. So now when we just look at GasBuddy data and some of the information, so we did get a nice spike for Labor Day. We had a nice spike on Thursday, Friday, and then again on Saturday. But then Sunday we saw a big walk down. So typically Thursday, Friday, Saturday, we averaged about, let's call an increase of demand by about 2.5%. But then on Sunday, we saw it fall by a little over 4%. So you're starting to see some of this friction. And now as we start to go through the data points and we start looking at, well, are people going back to work? What does this look like? And if you've been watching our economy show, many of these places, even though the offices are open, they're still empty, or offices still aren't open. And based on what the feedback is, 35% of offices don't even know when they're going to open again. So that's going to be an inherent problem. And just looking at bookings overall, again, coming back to imports, we have, again, 23 tankers or so heading this way, with another 9 that are already in the water, and that's going to only increase. So again, that's coming to when we talk about 30 or so boats, already signed up, with more coming. We should get to maybe about 35 overall, depending on how the arbitrage looks, because we did have that move lower. But Again, the demand, this is looking at GasBuddy data is looking at pump specific. So how much is moving through the pump, and people filled up for Labor Day. And then, that showed up the big pull, the big pull up in Thursday, Friday. So we need to see that continue. And we just don't think we're going to get there. And just kind of connecting the dots now, because we've seen China, we just looking at how we look at the economy, we continue to see, again, these headwinds. And these headwinds overall is looking at mobility. We don't see the mobility that we need to see this gasoline really pulled through the system. China's had a big walk back, which is going to continue to weigh on, and by big, relatively speaking, because it's been kind of waffling around. But we think China is going to have significant headwinds, specifically going into the end of the year. And emerging markets remain that headwind, which, they closed the gap a little bit. It's the advanced economies. We saw huge spikes in the coronavirus in Europe. They've now overtaken new viruses versus the US, which again, it's not that there's going to be an issue in terms of new lockdowns or this. It's just the consumer is going to change what they're doing. And if the consumer changes what they're doing, they're not going to drive as much. They're going to avoid places. And that's going to directly lead to a reduction in not only gasoline, but also diesel and inherently jet fuel. So now when we look at the U.S. in terms of supplied, we've talked about that through the summer, we expected to average about 8.5 million barrels a day of demand. And we got pretty close. We were about 8.6 once you kind of factor in some of these benefits. And now you can see that big drop off. Now, again, calculated number, some of this will start to turn around as we have some backfill following the Labor Day season. But again, as we go through the shoulder season, you can see that the normal trend is down through essentially the middle of October. And we think that the trend is going to hold, but well below that 5-year average. So that's why, or I should say, well below the low point of that cloud, which again is going to just put more product in storage, and it's going to weigh on pricing, inherently weighing on refinery throughput, which inherently weighs on oil demand across the board. Now, when we look at jet fuel demand, same thing. We've been talking about how we thought demand was going to come down. We continued to see it fall. Now, we think that we're going to kind of flatten out here, as we've seen a little bit of an uptick in people that are feeling a bit better about going on a plane, a little bit more flights coming around. So I think we're going to see that kind of flatten out and hang around, let's call it between 850 and about 950, and kind of walk back and forth between those levels as we have some demand. But again, it's really nothing resurgent, surging back up. And we can see that in the TSA data. When we look at the TSA data, we had a nice little pop, which if we compare it to 2019, we normally see. Again, it's just we're going to fall within that range where we think we're going to hold that now 600 to, let's call it 600 to about 900,000 in terms of just where we sit as people are back to school. Some of these things start to normalize, and we just don't really see that real demand. Google mobility data, not much to say. This is picking up some of the Labor Day uplifts. So you see some uptick, obviously, in parks as people look to get out, take advantage of the long weekend. A little bit of an increase in retail and recreation, but again, not a huge increase. And it's something that we think is going to kind of walk back. Again, just showing you how that uphill battle remains as the demand really plateaus, and we think it just kind of normalizes along that trend line. Now, when we look at OpenTable, we had a big spike, for the Labor Day weekend. We had some good news out of New York. 25% occupancy is going to be allowed in dining starting September 30th. So we're starting to see a little bit of that normalization on the restaurant side, which again is just going to pull more food through the system, going to get people out and about. But the question is going to be, how does this really hold through, as we've seen adjustments within Europe, just with some of those spikes in coronavirus. Now, shifting to the OpenTable regional breakdown, the United Kingdom, we just want to show at the end of August, because they had a lot of incentives to get out and to go to the restaurants in August. And you can see that that's really kind of normalized and flattened out around, let's call it down 5% to up 5% in the United Kingdom. In the US, we had a nice spike for Labor Day, and now we're back down to, let's call it, what we think is we're going to hold at about 35%. We typically see this 55% when we go towards the weekdays and we see people maybe going home for, barbecues as we were in Memorial Day, Labor Day. So it's just, when we look at on a global level, we think we're going to kind of hold this 45, especially as we go through the winter months and it becomes harder to eat outdoors. So how many people feel comfortable going indoors? What is the occupancy rate? Because right now you can have a ton of occupancy outdoors, but as it gets colder, that occupancy is going to get cut. So we think that there's going to be that overhang as we go through the fall season. Some of those little data points, which is interesting, just looking at at New York City, just as a viewpoint, this is looking at total MTA entry. So this is looking at turnstiles into the subway across all 5 boroughs. And you can see how far off we are and how we only had a tiny little uptick as we came into the Labor Day season. So again, it's, on a 7-day moving average, we're averaging about 1.27 million people in and out, and we should be closer to about 5 million. And again, this comes down to mobility. This comes down to people going into the office. And now some of these people are still going to the office. It's just they're hitting the road. So a lot of times if you see a lot of congestion or traffic, it's really people that would normally be taking mass transit are now turning to and looking at, well, can I drive? Can I take an Uber? Can I do something that is above ground and not within the subways? So that's where we're starting to see some of these breakdowns. Just thought it was a little interesting point, looking at New York, because even though New York is like this, it seems as though a lot of other major cities are still experiencing something similar, where the New York offices are averaging, let's call it anywhere from 5 to 10% occupancy, and most of the other major cities are closer to 15 to 25%. So you get an idea of where that pressure still remains as work from home is prevalent. Some of these areas remain shut down. And then obviously we have the issues within California with the wildfires, people sitting home and maybe avoiding some of this travel, which again is going to weigh on gasoline demand outside of normal seasonal levels, which is going to put additional weight on that PADD 5. So these are things that we're always watching. And then in the next segment, we're going to talk about exports and how is this really being impacted in the global market overall.